We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Julian Brigden, co-founder of Macro Intelligence 2 Partners. Thanks for joining me today, Julian. How are you?
Great, Tom. Thank you very much for having me on the show.
Great to have you back, and I'm really looking forward to digging into some of these issues with you today. And I was wondering if we could start by asking a bit of a broad question. Is there a major inconsistency between what you're seeing in the equity pricing right now versus what the bond market is pricing right now?
Yes, in a word. Neither of them are pricing in, should we say, an utterly implausible scenario, right? So we have an equity market which is, broadly speaking, a little recessionary, right? A little recessionary. So you look at outside the sort of big top seven, right? We've seen areas flag. So they definitely sort of anticipate some sort of period of slow growth, but none of them are really priced for what I would call for a true recession. And there's a lot of talk of this sort of soft landing camp, and then ultimately a re-acceleration of growth. So you look at earnings projections, we've got a period of softness, and then natural inclination of the bulls in the equity market who dominate the equity market, and obviously the sell side who's the clue is in the name, right? They're trying to sell you something, and it generally isn't put. It's a bullish scenario. So they then expect growth to reaccelerate. Plausible. But when you look at the bond market, it is pricing in quite aggressive cuts still. And it is the long end of the curve is priced to a point where you would expect you've got to start to see those cuts come through. And that's more recessionary, and it's certainly heavily vanquished inflation. And it's that interchange which I find inconsistent. It's that interplay of those two scenarios. As I said, neither scenario are on a standalone basis implausible. When you put them together, there's an inconsistency there. And in particular, the inconsistency from my mind stems from something that we call hyperfinancialization. And that really is a word to describe or a phrase to describe the relationship between the equity market and the real economy. So if I said to you, Tom, which kind of leads, which is the chicken, which is the egg, does the real economy lead financial markets, or does the financial markets lead the real economy? You would probably say, well, Julian, logically speaking, it should be the real economy. The real economy sets inflation, it sets growth, it sets employment, all of these dictate bond yields and profit levels and so on and so forth. So it should dictate what goes on in the bond market and in the equity market. That doesn't happen in the US. Statistically, the equity market leads the real economy because that's all that CEOs give a shit about, to be brutally frank. Right? They get paid on the basis of this. They're remunerated in stock or stock options. And so the only thing that really determines what they do in terms of two very important metrics, employment and capex, is what happens to their stock prices. And what we've seen since the start of the year or the end of last year, this strong recovery in the equity market, has helped to reverse some of the softness that we were seeing in the data in the first half of the year. So if you looked at the first half of the year, you were seeing very clear signs of layoffs. In fact, you started to see them, particularly in the tech sector. And those have essentially dwindled to nothing now. So if you put your money, then you would say, well, kind of the equity market looks like it's got it right. Okay, that this is going to be to bring that all forward, the transitory word, what's going to be transitory is this weakness. We're going to have this period of kind of softening growth here, not really going to go into recession, and then we're going to take off again. And in that scenario, the bond market is out for lunch. There's no way that the Fed is going to be able to deliver rate cuts of the degree that they are priced. Now, could you get 25 basis points off if inflation drops and stays down, or even 50, so that they don't let real rates get too tight, Tom? But, the answer is yes, you could, but you're not going to get hundreds of basis points off. And that's where I see this inconsistency. What's more is you could reignite inflation again in a reacceleration of. Let's be honest. I mean, we've got very, very, very low levels of unemployment, right? And the sort of camp that suggests we've got this nirvana of reaccelerate, ding dong, the witch is dead, as I like to refer to it, in terms of inflation, right? It's vanquished, it's gone. Mm-hmm. And now that means we can just reaccelerate growth again. It's pretty hard to do it when you've got under 4% unemployment and not create wage pressure.
You and I were talking a little bit about that before we hit record this morning, about the idea that there is such tightness in the labor market. Is it possible that that is an artifact of having, as you said, losing more of these high-paying, white-collar, career-type jobs and more people going into these lower-paying 2 or 3 part-time jobs to replace that full-time salary?
Yeah, I mean, the US doesn't have a very high quality labor market, right? We have a very small cohort of highly paid specialists, and then a pretty large swathe of poorly paid, and in many cases, unfortunately, poorly educated people. And that's a problem. That's a problem for the US. But in general, when you look at, I think there is tightness there. So if you look at, say, teen unemployment, it's ticked up a little bit recently, but it got down to sort of post-war tightness, right, that we've ever seen. And, this was always the one that I was looking at to sort of as a metric to how tight things are, because this was a cohort who wasn't about to retire. They just entered the labor force, didn't care about COVID because they're teenagers and they weren't ever going to die, and were quite willing to work, and their unemployment collapsed, right? And it's still very, very, very tight. So I think we can bemoan the quality of some of the jobs, but I think it's hard to dismiss the fact that there's still quite a lot of job demand out there. And, people talk at the job status starting to soften, and it is. Don't get me wrong, the demand for jobs is softening, mm-hmm. but there's still excess demand for jobs. I have a metric which I like to use, and it is a kind of a job demand model that we use, and we run it against the unemployment rate. And when it was at its tightest, where demand for jobs was at its highest, if people had been available to hire, it would have suggested that the unemployment rate would drop to 1%. Right now, that's absurd, right? You've never seen anything like that. And clearly, they just couldn't find the people. So that's why we had these big divergences between job hires, actual hires versus job availability. Now, it's softened since then, Tom, but it still suggests that if firms could hire people, unemployment would be under 3%. So there's still a mismatch here. So yes, things are softening, mm-hmm. but it's softening demand, not yet job cuts. And that, to me, is the big imponderable, one of the big imponderables at the moment. Can we go back to a period of accelerating real growth without losing jobs? Right? Because my view is there just isn't enough slack to have that period of, inflation's over, we'll go back to high real growth, above trend growth, is what equities are pricing, and somehow we'll have no underlying wage pressure or feeding into inflation. That I just don't buy. Mm-hmm.
Julian, what do you think could tighten financial conditions to the point that we get a repricing in equities and bonds to the point that the Fed will have to react here?
Well, it could be any number of factors, right? And it comes back to that, which is right, which is wrong, right? Is it the bond market that's right, or is the equity market right? Or wrong, vice versa. So, the equity market, the equity market is very stretched versus underlying liquidity. The Fed is still doing QT. It could be a correction in the equity market. That would instantaneously solve all our problems, Tom, right? You get a 15% drop in stocks, then your data will start to roll over within weeks, literally weeks. And it will create that impression of the recession, and then we'll take all the froth out from hyperfinancialization, and you'll be left with tightening lending standards, a housing market that is definitely starting to show signs in terms of the construction side of the equation slowing. So you could go straight, don't pass go, don't collect your $200, go straight to jail. You're in the recession. The second thing that could do it is you'd have to see something from the labor market, from the bond market. Maybe it's higher for longer, where we just kind of grind this thing out. Mm-hmm. Problem with that is that the equity guys don't know what a 5-year treasury looks like, right? They only ever look at 10-year treasuries and Fed funds, right? That's all they ever look at. And that's where the mispricing is in the bond market, because the curve kind of drops, right? And that's what would need to reprice in a higher for longer. Or the other one, which is intriguing but dangerous, is you could have a situation where, and I think this is a risk, so let's say, and this is the message we're getting from the Fed, that the Fed says we're done. Right? We just had Chris Waller, who was one of the hawks, come out and say, we don't need to go in September. Okay? So the sort of mission accomplished message, okay? And then inflation reasserts itself. Now, I think inflation will partly reassert itself because of base effects. Oil moving up is not going to help either, which is clearly what it's doing at the moment. And that becomes a bigger issue as we move into Q4. So the Fed sits there and says, we're done, in the face of headline inflation that still bounces back, and core inflation that is still robust, Tom. And then what you could find is the long end of the bond market comes under pressure. And we know that that's already a wobbly area, where we're worried about ratings of the United States, where we're worried about the amount of issuance that's going to have to come through. If you started to see a Fed that was less hawkish in the face of either a rebounding growth, so we go through the soft patch and then we rebound, and or a reinsurgence of inflation, that would really reprice the bond market pretty quickly. And I think that the long end of the bond market is where you could start to get some real dangers, because we know that that's certainly what the NASDAQ gets very uncomfortable with.
Right. Julian, if we look at both parts of the equation of, real growth versus inflation, you laid out your case for inflation going back from 2017 based on the fiscal and monetary policy setups of that time. So, considering that at that time the Fed couldn't hit its inflation target of 2%, what did you think back then would be the catalyst to actually get inflation higher?
So it's this is something I think that a lot of commodity bulls have been thinking about for a time. There are big cycles in history. We know there's a great work done on the fourth turning and all those various sort of cycles. And basically, what they're talking about are societal pressures, right? Societies change over time. They demand certain things. That work is suggested it's related to age, but there's all sorts of cycles that we kind of go through. And we were talking back in sort of 2017 and 2018 about how, as the boomers started to retire and the millennials were left, burdened with debt, unable to afford expensive assets, so they would start to demand, governmental change. They would start to demand support so that they could enable them to buy houses, however that came about. They would demand higher wages. We're looking at a shrinking working population, all of these kind of factors. And all of those things were, broadly speaking, slightly less deflationary. We also talked about the ending of sort of globalization, that we'd hit peak globalization. We started to write that in 2018. And it was in plain sight. It was just the relationship which, is frequently referred to as chimerica, that sort of Chinese-US symbiotic relationship. It just reached the point that it wasn't really working for anyone anymore, right? And so there were factors that were slowly starting to reverse some of these disinflationary factors. And then you get to a point where COVID hits and it just accelerates this thing massively, Tom, right? Massively. So you get to a situation where you're like, okay, and I think Trump was kind of a manifestation of the societal unrest element, right? He was the first person who kind of ripped the cap off fiscal spending, right? There'd been a long, long period where governments had talked about reducing debt and not being overly profligate and controlling spending. And then Trump comes along and just goes, I've rediscovered fiscal spending. Isn't this great? Right? Money for all my mates, right? And now, then we had COVID, and now we've got Biden, and we've seen the same attempted, in other parts of the world. And this is very predictable if you go back and look at history. And the closest analogous period that we had seen was basically the mid-60s. Nothing's ever a perfect rhyme, but the cycle is kind of there. And we think we're in a period where the demands on fiscal spending are increasing, both from a societal perspective, and we're also fighting arguably three wars. And wars are the most profligate spending environment. We've got a hot war against Russia, a cold war against China, and a climate change war. And all of these, Tom, are going to demand vast quantities of spending, right? And, you set in that sort of scenario, I think, a much more structurally inflationary environment, and one where bond yields potentially rise, or it's vulnerable to inflation, let's put it that way. And so that's kind of been our structure for a while, that we're moving into a world where we need to run nominal GDP quite high to pay down the debt, right? Nominal GDP has to be above your debt interest rates, right? And the question for markets is it more inflation in that nominal GDP or more real growth? And how that mix kind of moves determines where you want to be in your asset allocation. And history suggests it can shift quite quickly. So it's a much more volatile period going forward than we've had. But that was kind of our structure all along, that we thought the cycle changes, let's call them geopolitical changes, were inevitably leading us to that point. We thought it could take 10 years, right? COVID comes along and it's taken 5 from when we first wrote, started to structure that view. And things seem to be developing insanely rapidly.
Yeah, absolutely. Julian, when we're thinking about let's say the kind of these two eras, I had Lynn Alden on the show a couple of weeks back, and her and I talked about the era of inflation of the 40s versus the 60s to 70s. And, you mentioned the idea that we're fighting wars and we also have this debt load problem. Are we really in a combination of those two eras right now with the problems that the Fed has to fight?
So, the answer is, I think, here's the thing. In the 40s, it was a post-war period. So I think if there is from the war perspective, I think the 60s are the better analogy than the 40s, because we're very much in the acceleration of war-related spending rather than the waning of war-related spending. And look, you could say that COVID, don't get me wrong, like in the 60s, you had 3 waves of inflation. And each one had a higher amplitude. In the 40s, you had 2. The first one was the big one, and then there was the second one. Are we going back to COVID levels of inflation or more? I hope not, Tom. But could we go back to 5 or 6 headline and get stuck with core at 4, or goes down to 3 and then goes back to 4? That, I think, is possible. So I don't want to get stuck on and overly emphatic about the ultimate level of inflation, but I think we are prone to a more inflationary environment and a higher bond yield environment, in part because of that, but there's other structural problems going on, which I think will keep bond yields quite elevated. And as I said, when it comes to war, we're really entering the war phase. The war phase isn't behind us, right? So if anything, as I said, my analogy has always been the 60s into 70s. We're not in the 70s yet, because what triggered the 70s was a weak dollar, but we'd already seen 2 waves of inflation in the 60s.
Considering that time as well, Julian, another point that was brought up kind of as a cause of that type of inflation that we saw was that societal piece that you were talking about, is this glut of baby boomers coming of house buying age and all of the expenses that are associated with that. This
right.
era
Johnson's Great Society in the mid-60s.
So this era of a large expansion of bank credit being demanded. So in that scenario, it seems to me that raising interest rates is a very direct tool to slow that type of growth and or inflation. Are we looking at, those same tools being used on a problem that is 1 or 2 steps removed currently?
So, look, interest rates are an effective tool, but they're a very blunt tool, right? I think it's entirely possible that what we're seeing, Tom, is a delay. As I said, I think my view will be a lot of that, a delay in the effects of the tightening. I think, some of that has to manifest itself via the equity market. So in other words, have we done enough yet to ding the equity market? Is the data weak enough to ding the equity market? It doesn't appear so at the moment. But the lag thing, I think, is a very valid question, and offsetting that is fiscal. And when you come to the lag, part of the problem in the lag is that, as in the equity market, and we talked about this right at the beginning, we've got this very much bifurcated equity market. You've got the Magnificent Seven and other companies in that ilk, and then you've kind of got the rest. And the Magnificent Seven sit on cash. They're better off. They're earning 5%, right? The rest, particularly small businesses, are paying 8 or 9% now for their money, right? So you've created this haves or have not, right? And since the overall index is dominated by the big boys, it creates this impression that all is well. Whereas in actual fact, when you look underneath the surface, there are cracks. In the real economy, we have the same effect. Interest rates are definitely hurting, right? But we know that the corporate sector, certainly not just from an equity perspective, but termed out a lot of their debt, right? So they don't have to pay that debt until next year, the year after. That's when we know a lot of commercial real estate's going to reset, right? That is definitely going to be a period of reckoning, okay? We also know that a lot of, on the individual side, if you're wealthy, you own stocks and you locked in your mortgage rate at some reasonable level, what's the Fed done for you?
Mm-hmm.
I mean, done to you? Nothing, right? Absolutely nothing. So I think, whereas, if you're a millennial and you're trying to buy a house and you've got to fund a car and you've got to pay off student loans, right? Friggin' sucks. So there is definitively, there are problems, and the US economy, I think, will have strains and issues next year if rates do not come down. And I think that's why the Fed is pursuing the policy that they're pursuing, and that ultimately things will slow. The wild card is fiscal, and the wild card is the equity market keeping things buoyed in the interim. And the longer that they stay buoyed up, the more work that the bond market has to do to try and tighten these financial conditions. Because really, if you break down a financial conditions index, Tom, and there are roughly kind of 5 components. Some sort of short-term interest rate metric, call it Fed funds or 2 years or whatever you want to pick. A longer-term one, call them 10 years. The dollar, credit spreads, and equities. Okay? The only bits of that equation that have done any material tightening is 2-year yields and 10-year yields. So the short end and the long end. Credit spreads tightened for a bit, now have eased again. The dollar rallied quite hard, now it's eased again. And equities have just gone the whole time, right? I mean, this is the fundamental problem. Is the Fed going to get their way? If they can stick with higher for longer, they will grind this baby out, right? And we will see at some point, I would think, equities have to wake up to the reality of slower growth. But we're not yet at that point, and until we're at that point, and this is why this is a tactical right here, right now, trading environment, you are essentially trying to play off bonds and equities to do that continued tightening. Because to me, the idea that even if inflation is truly vanquished, just wake up tomorrow morning and there is zero inflation, if nominal GDP stays at the same level, so the labor market remains solid, wage growth remains as it is, all that has to happen if inflation goes to zero is real growth has to accelerate to the level of nominal GDP. And that means above trend real growth. Trend real growth in the US is about 1.75, according to Jay Powell. Some people have it a little bit higher, but JP said it's 1.75. Okay. So you grow like we did in the last quarter above that, then you're going to put pressure on for companies to hire more people. Sure, AI in 5 years' time will help offset that, but not this month, right? And that to me suggests that you'll just stoke wages again. And that means just core inflation remains a persistent problem through 2024. Mm-hmm. And so we're still in this situation where if equities rally, bonds have to weaken. If bonds weaken too much, then equities kind of sell off a little bit. We're in this kind of, I don't know if you've ever driven a manual car, right? Where you try and balance the clutch, right? And it's a bitch, right? And it's really tough to do, particularly when you're on a hill. And that's kind of where I think we are right now. It's which one of these things give. And it goes back to your original question, where's the inconsistency? Neither of them is ultimately inconsistent in terms of neither story in the bond market or the equity market is implausible. It's just that combination seems highly inconsistent to my mind, and something has to give.
Right. Yeah. Separately, they're maybe reasonable, but together they don't really make sense.
They don't chime. Yeah, exactly.
Is it possible that the Fed ends up having to change their inflation target and target higher inflation, which I know has kind of been recently, let's say, floated through a couple news stories to maybe gauge public sentiment on?
The trial balloon idea. I think Powell has been pretty emphatic about no. I think there's a reason they daren't do this at this point, right? There's no way that you can say we're loosening to 3 before you've hit 2, and definitively 2, because the bond market would go, oh my God, I'm out of here, right? And you want to get the US into trouble, you start pushing up long-term interest rates in an uncontrolled way and starting to build in insurance that the bond market will want, that you're not going to be as tough and preserve the value of their investment. So I think, is it something we could end up in, Tom, 5 years from now? Entirely possible that we move. Let's say we move. I think more likely is we move, and this was something that was debated when Janet Yellen was around, that we move to nominal GDP targeting. So some combination, nominal GDP being made up of real growth plus inflation. So some sort of mix. They'll say, yes, obviously low inflation and more real growth, but it doesn't really matter. And the reason you move to a nominal GDP targeting, as I said, is that because it enables you, as long as it's high enough, to pay your debt, right? That's all you care about, because you don't care about paying it back in real dollars. You're paying it back in nominal dollars, right?
Right.
But not now. I don't believe the 3% thing now. I think that's hogwash.
Mm-hmm. As part of that, let's say that idea of the debt load right now, is the Fed now aware of entering this phase of fiscal dominance, and can they even avoid that outcome considering how much debt there is?
Yes, I think they are. I've certainly, from my contacts with my old sort of friends who are in the policy space, there seems to be this relatively recent recognition of, whoa, there's a lot more fiscal than we thought in the pipeline. I think in part that they're using that to explain why it's taken longer for policy to bite than it should have done. The next bit, though, is a tougher one, because essentially you're asking, correct me if I'm wrong, is the Fed able to stand against, or willing to stand against, government's fiscal profligacy, right? If government decides they're going to spend, will the Fed stand against them? Now, we've seen in the, and this is an age-old debate, right? This is, what's the objective of the Fed? And a very good friend of mine, Mike Taylor, always said, do remember, Julian, number one job of a central bank is the solvency of its government, right? And ultimately, he's absolutely correct. In that scenario, what you'd expect to do is, let's say we do end up continuing to fight these 3 wars. We need governments to continue to spend very heavily to do it. We've got all those social demands from those millennials saying, wait a second, I need some sort of subsidized mortgage. I need, higher wages. I need to afford those assets, et cetera, et cetera. Is then the Fed willing to say, I don't give a shit. It's not my mandate to allow this economy to rip and see inflation. My mandate is simply employment and inflation, and growth is running too high, courtesy of this fiscal spending. So here you go. I'm Paul Volcker Mark II. and shove their fist down your throat and hike rates to whatever level is necessary. Mm-hmm. Now, if you listen to the rhetoric, that's what Powell wants you to believe. I mean, that he is, Volcker reincarnated. He is not, though. And already, Tom, I can see signs of a Fed that is desperate to avoid a hard landing, which means it doesn't have that resolve, is cognizant of social pressure. This is a woker Fed than we've seen in a long time, in part because of political appointees to the Fed. I mean, Powell isn't nor someone like Chris Waller, but we know that there are other Democratic appointees who are much more in favor of, letting it run hot, let's employ everyone in the labor market, let's get all the minorities in, and none of those are wrong. They're highly laudable suggestions. They just have market consequences, okay? And I think there is a real risk that at some point the Fed is forced to cross a Rubicon. And that Rubicon is where they decide between what is best for the inflation situation and what is best for their boss, government, right? And this is the debate. This is what happened in the late 1960s. In the late 1960s, we had a Fed, inflation started to break out. We had a Fed that got resolutely tough, right? Tried desperately to raise rates to offset this. Back then, we had the dollar was in Bretton Woods, a fixed exchange rate mechanism. It was watching gold literally leave Fort Knox because the US economy was running too hot. We were running a large current account deficit and that we were having to pay for it in gold. What they should have done as we were fighting this war, we had this is where this phrase guns and butters comes from, Johnson's Great Society and the Vietnam War spending, keeping things pumped up. What the Fed should have done was raise rates, crush the domestic economy, kept the dollar in the system, and forced government to pay higher rates. It didn't. There was a conscious decision made by the Fed who referred to their sort of founding documentation, where they said basically the Fed is independent within government, but it's not independent of government. And they basically subsidized government spending in the late 60s through some form of quasi QE. And the net result was that the dollar got annihilated. Mm-hmm. Took time because we had a fixed exchange rate mechanism. But I think this is what a lot of gold believers are hoping for. And I think they're probably right. I could see at some point down the line, if we have persistent structural inflation with a government that's trying desperately to fight these wars and fund these wars, and the long end is under pressure, and we've got these question marks about the creditworthiness of the US, that the Fed ultimately has to step in and kind of try and support government spending in some indirect way, whether it's yield curve control, more QE. The big thing that I say disagree with some of my peers about is I don't think that's a step that they will take lightly, Tom. I think it is as much as the Roman general stood on the edge of the river Rubicon and looked at Rome and said, if I cross this, this is really, I am a traitor, right? That is exactly how heavily the Fed will weigh that decision. So I think it has to come about from pain rather than just some sort of, screw it, we'll go to 3% inflation target, we'll do YCC or more QE even if inflation isn't cured. And, we go straight to nirvana of just an equity market that just accelerates away on the back of the printing press again. I don't believe that's the case. I think certainly this Fed, as it stands at the moment, would fight that vehemently, at least initially.
Mm-hmm. Yeah, it's really interesting to think about what, let's say, conditions present a great situation for gold and what ends up leading us
Right.
to that situation. But, Julian, you're talking about yield curve control, and ultimately, I think who ends up buying the US Treasuries. Obviously, Japan in the past has been a major buyer, but you guys have a section on your website called Japan Update, where you're constantly keeping an eye on Japanese data and changes in that market. Why do that, and what risks do you see, let's say, Japan posing to the rest of the financial world here?
So look, we got into that because no one else was doing it. Everyone had kind of died out and stopped looking at Japan. And I'm lucky enough to have a colleague who's followed Japan man and boy for sort of 35 years, beyond fluent Japanese speaker. And so we kind of got into it. Japan is a really interesting one. I mean, Japanese flows are pivotal to global bond markets. That's really their biggest influence. And so this kind of move that we've seen to move away, not from zero interest rates per se at this point, but from yield curve control, which Ueda in particular, my sense from talking to policy friends is that he believes it was a flawed policy, okay, yield curve control, has moved away from that. And I think what happens in the JGB market is singularly important to set global bond yields, and it's been one of those that has been influencing what's been happening in our end of the bond market too.
Yeah, there's a lot of talk about Japan and how they ultimately, defend the yen and or their bond market, kind of stepping away from that peg, again, trying to really be able to do that balance of the.
Yeah, it is. And I do think we're getting to the point, we're pretty close. I think 150 is going to be the line in the sand on the currency. I would not I would not be surprised to see them come in and do something. We'll see. They're in a difficult situation. A lot depends on their growth situation. They do want a slightly weak yen because they're trying to re-onshore business from China back to Japan and attract that. I think the US is willing to go along with a slightly weaker yen than normal to do that and to bring them back into the Western fold as a technology producer and out of China. And then we are back into that era of what I would call big boy politics, where it trumps purely just macroeconomics. But there is a limit even there, right? The US is not going to want to see it. And certainly the Japanese don't want to see this thing run off because they're very much in the believer of sort of good inflation, bad inflation, right? There's good inflation where it's generic, internally generated higher wages, et cetera. And there's bad where your currency just gets dinged and you just import, inflation.
Mm-hmm. Excellent, Julian. Well, I think that's a good place to wrap up today's conversation. You guys have a global macro summit coming up towards the end of this month, right?
We do, yeah. 26th, 29th. If you're interested in turning up in person, certainly if you're local, we're going to hold it in Vail. It's a stunningly beautiful time of the year to come out there. But if you can't make it in person, we're actually starting, I think as of last week, we started to sell virtual passes. So you're going to get access to everything. All the speakers, you can go on there and look at the speakers. This is really something, Tom, that we've really tried to do. It's been my objective for a while. I go to a lot of these conferences. I hear a lot of very smart people talk, but sometimes I leave a little disheartened that nothing concrete came out of it. What am I supposed to do with all this great information? Mm-hmm. And that's something that we really are trying to address in this. So we've got a couple of registered investment advisors, so really true wealth managers, coming to talk about how they see things developing, how they think you should position your portfolio. And we also got some great traders who, if you're interested more on the trading side, who are going to come away with some really concrete ideas.
Excellent. And of course, more information and all of your guys' stuff is available on the website, mi2partners.com.
Yep.
At Julian MI2 on Twitter and also your guys' Substack, mi2partners.substack.com, right?
Yeah, exactly.
Perfect.
Cheers,
so
Tom.
much for your
Thank
time
you very
today,
much.
Julian.
Pleasure. Thanks, everyone.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.